I used to think I was doing everything right with my money. I'd save a little, throw some into whatever stock was trending, copy what my coworker was doing. Then I'd check my account every other day, hoping it would grow faster. But then I noticed something strange. Two of my friends, same age, same income, were way ahead of me financially. Not because they were smarter, not because they worked harder, just because they picked a plan and stuck with it. That's when it hit me. The biggest risk with investing isn't losing money, it's not having a plan at all. Most of us bounce between strategies. We chase the next big thing, or we wait too long afraid of making the wrong choice. And meanwhile, time is passing. Disclaimer: this video is for educational purposes only and not financial advice. Investing involves risk, including loss of principal. Past performance does not guarantee future results. So in this video, I want to show you a better way. A simple 4 ETF portfolio I use myself. You don't need to be an expert. You don't need a financial advisor. And no, it doesn't involve picking the next hot stock. But there's a twist. One of these ETFs works very differently from the others. And once you see how it fits in, you'll understand why this setup has worked through market ups, downs, and everything in between. Let's get into it. When people say the market is too risky, what they usually mean is they didn't have a plan when it dropped. See, the problem isn't the market. The market moves up and down. That's normal. The real problem is how we react when it gets scary. Think about it. When the market is up, we feel confident. We want to invest more. But the second it drops, we freeze. Or worse, we pull out completely. That emotional swing hurts way more than any downturn. Why does this happen? Because deep down, we crave comfort. We chase safety in the short term, even if it costs us in the long run. That's human nature. That's why I believe in building a plan that works with your emotions, not against them. This 4 ETF portfolio is exactly that. It's simple. You don't have to watch the market every day. You just invest, step back, and let it do the work. Not because you're lazy, but because you're smart enough to know your time and energy are better spent elsewhere. And here's the cool part. By the end of this video, I'll show you 3 versions of this portfolio based on your situation, whether you're growing, planning, or already retired. But first, let me quickly talk about 2 kinds of ETFs that most people think they need, but in this plan, I leave them out for a reason. Let's be clear. The 2 ETF types I'm about to mention aren't bad. They're not dangerous. They're just not needed for this simple setup. I'm talking about bond ETFs and international ETFs. Both sound safe and smart, right? That's what I thought too, until I looked closer. They're part of what I call the old way of investing. Back when access was limited, the world wasn't so connected, and you needed to build your portfolio like a fortress, lots of separate walls just in case. But things have changed. The markets are faster. Information is global. Companies operate in dozens of countries, and the way we build portfolios should reflect that. So for this strategy, I've swapped those out and replaced them with something that still offers protection, but with way more potential upside. Let me show you exactly what I mean, starting with bonds. Bonds are kind of like the mattress of the investing world. They're where people park their money when they want to feel safe. No big gains, just slow, steady, please don't hurt me kind of money. The idea is simple. You lend your money to a government or a company, and they pay you back with interest. Historically, when the stock market crashes, bonds usually hold up better. That's why people include them, to balance out the wild swings. But here's the thing. In the last 5 years, bonds haven't really done their job. In fact, many broad bond ETFs have actually lost value, around -5%. That's not protection. That's just a slow leak. And with rising debt levels and interest rate shifts, a lot of smart investors, myself included, are rethinking the role of bonds in a basic portfolio. Now, I still believe in having something in your portfolio that helps cushion the fall, something that keeps your plan alive even when the market dips. But it doesn't have to be bonds. There's a better way, and that's what I'll show you next. Let's talk about international ETFs. Now, at first glance, they sound smart, right? The world's a big place. Why not spread your money across different countries?
That's what I used to think too, until I looked at how things actually work today. See, 30 or 40 years ago, if you wanted a piece of the global economy, you had to buy companies based in other countries. The internet didn't exist. Trade was slower. If you wanted exposure to Europe, you had to invest in European stocks. But fast forward to today, and everything's different. Right now, someone in Germany is sipping Starbucks. A shopper in France just bought from Walmart's online store. Microsoft is running businesses in every time zone. Big US companies are global companies. You don't need to buy a company in Japan to benefit from the Japanese economy. Apple already sells there. And here's the clincher. One of the most popular international ETFs, VXUS, has averaged only about 5% per year since it launched, and that includes a huge year in 2025 when it temporarily beat the US market. So if global exposure is already baked into US giants and international ETFs are underperforming long-term, why complicate things? Now, if holding international stocks helps you sleep better at night, go ahead and add a small piece. But for this setup, this clean, simple portfolio, I'm keeping it focused, powerful, and easy to manage. Let me show you the first core piece of it. This is the one I call the foundation. It's not flashy, but it's strong, and it's what does most of the heavy lifting in my long-term plan. I'm talking about an ETF that tracks the S&P 500, basically the 500 biggest public companies in America. You've got great options here. VOO from Vanguard, SPYM from State Street. Both do the same thing. They give you a slice of the 500 most successful US businesses, from tech giants like Apple and Microsoft to consumer leaders like Costco and Berkshire Hathaway. Here's why I love this as the base of any portfolio. You don't have to pick winners. You don't have to time the market. The index does the work for you. If a company stops performing, it gets removed. If a new leader rises up, it gets added. Your ETF stays current without you lifting a finger. And the track record? Around 11% average yearly growth since inception. That's through wars, recessions, dot-com bubbles, pandemics, and more. That's why this is the first layer of my 4 ETF strategy. It's broad, reliable, and it puts your money to work in the companies shaping the world. Next, let's talk about the engine that pushes your portfolio forward even faster. Let's add some speed to the mix. The next piece of this portfolio is all about growth, the kind of investing that can really push your wealth forward over the long run. But here's the key. We're not chasing random tech stocks. We're not guessing who the next Tesla is. We're using an ETF that gives us smart, broad exposure to innovation. It's called QQQM, and it tracks the Nasdaq 100, the top non-financial companies on the Nasdaq exchange. That includes names you know: Apple, Nvidia, Microsoft, Amazon, and Google, companies shaping the future. Now, you might have heard of QQQ, which tracks the same thing. They're nearly identical, but QQQM has a small advantage. QQQ has a lower fee, 0.15%. QQQ charges 0.20%. It may seem small, but over decades, lower fees help more of your money grow. And growth is what this fund is all about. Over the last 10 years, QQQM has averaged around 19% per year. That's powerful. But it also comes with a warning. What goes up fast can also drop fast. Tech and innovation stocks can be volatile. So while QQQM is the engine of this portfolio, we don't want it to be the whole car. That's why the next piece brings something very different to the table. Something slower, steadier, and built to hold up when things get rocky. Now let's talk about the ETF that keeps you grounded. It's called SCHD, and it's kind of the opposite of QQQM. Where QQQM is all about the future, SCHD is built on companies that have proven themselves over time. This ETF focuses on U.S. businesses with strong cash flow, consistent dividends, and good fundamentals. Think of companies that people rely on no matter what's happening in the world, even during a recession. Why include this? Because when markets drop, excitement disappears, but reliability stays. SCHD has had a slower couple of years, and that makes sense. The spotlight's been on AI, tech, and growth stocks. That's where all the hype and headlines have gone. But long-term investors know that the market moves in cycles. What's boring now often becomes the best deal later. And while SCHD may not shoot to the moon, it pays you in cash. Its dividend yield provides steady income, even when prices move sideways. So this fund gives your portfolio stability, income, and a bit of emotional calm when everything else feels uncertain. But what if I told you there's an ETF that mixes both worlds, growth and defense, in a way that actually adjusts itself as the market changes? That's what I'll show you next, and it might be the most interesting part of this strategy. Now here's the wild card, the ETF that surprised even me. It's called SPMO, and it plays a different kind of game. It doesn't just sit on the same 500 companies like the S&P 500. Instead, it picks the 100 stocks within the S&P 500 that have the strongest momentum, the ones that are already moving up and showing strength. Think of it like this. If the market were a race, SPMO finds the runners who are pulling ahead and keeps rotating into them. That's called momentum investing, and SPMO does it automatically. It rebalances every 6 months, which means your money is always leaning into the stocks with the most upward power. It holds around 100 stocks and charges just 0.13% fee, which is very low for an active strategy like this. And here's what really caught my attention. In 2022, a rough year for stocks, here's how these ETFs performed. QQQM dropped 32%. The S&P 500 dropped 18%, but SPMO only dropped 10%. That's huge. It means you got a similar ride up over time, but with less pain on the way down. And speaking of the long run, SPMO has averaged around 18% per year over the past decade. That's right up there with high growth funds, but with less of the stomach-churning drops. So you're getting a blend of growth and defense all rolled into one smart fund that adapts as the market changes. That's why I call it the unicorn. It's rare, balanced, and kind of brilliant. And now that you've seen all four, the base, the engine, the shield, and the accelerator, let's talk about how to mix them together based on what kind of investor you are. Alright, so how do you actually put all of this together? Well, it depends on where you are in life. I break it down into 3 types of investors. See which one sounds most like you. First, the accumulator. You're probably still working, far from retirement, and have a steady job. You want growth, you're okay with some risk, and you've got time on your side. Here's a simple mix. 30% SPYM, broad market base, 25% SPMO, momentum tilt, 25% QQQM, growth engine, and 20% SCHD, dividends for stability. And don't forget to keep 3 to 6 months of living expenses in cash, just in case life throws you a curveball. Second, the planner. You're getting closer to retirement, maybe 10 years out. You still want growth, but you also want to protect what you've built. Here's a mix. 25% SPYM, 25% SPMO, 20% QQQM, and 30% SCHD. Here, I'd suggest keeping about a year's worth of expenses outside the market, again, just for peace of mind. And finally, the retiree. You're already retired or about to be. Your top goal is keeping your money safe while still earning something on it. Here's a more conservative blend. 50% SCHD, 25% SPYM, 15% SPMO, and 10% QQQM. And this part is crucial. Keep about 3 years of living expenses in safe, liquid accounts, like high-yield savings or short-term treasuries, so you're not forced to sell during a dip. Some retirees might even add a small slice of bonds, depending on taxes or required minimum distributions. But the point is, your strategy should match your life, not someone else's. Now, before we wrap, let me leave you with one simple rule that makes this all work. Keep it simple, keep buying, don't react. That's it. You don't have to time the market, you don't have to predict anything. You just have to build a plan that works for you and stick with it. And if this helped, The next video is all about how to set this exact strategy inside a Roth IRA or taxable account, and the small mistake most people make that ends up costing thousands over time. So make sure you're subscribed to this channel, and tell me in the comments, which one are you? Accumulator, planner, or retiree? I'd love to hear how you're approaching your future.